Kia ora. Welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Leighton Roberts and I'm one of the co-founders and co-CEOs at Sharesies. Today, we thought it was time that we brought you a little bit about the property market, particularly this close post-election. And who better to analyse this than independent economist Tony Alexander. Thank you so much for joining us, Tony.
Yep, no worries, Leighton. Thanks for having us on again.
Great to have you. Just before we get into some material, we're going to start with some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Well, look, Tony, thanks for joining us. I'm excited for this conversation today. Everyone knows how close to the heart property is for New Zealanders, and as a homeowner, I'm pretty interested to hear what you're up to as well. And it's right on everyone's tongues at the moment. Conversations around what's happening with their interest rates, that ties into cost of living and all that stuff, of course. But look, we're still a few days away from confirming the coalition government, but we think there will be changes, and it's likely that some of that's going to relate to housing in particular, and with some of what's been proposed there, and we're pretty interested to see how we think that's going to impact both buying and selling in the market. We know it's been pretty quiet, quite the lull there coming to election, which is pretty normal, but interested to see how that normalises from here. So if we can just start, Tony, with you, we'll start with demand, and what are the indications that you're seeing in the market at the moment with regards to demand, and whether there's any coming back, or if we're still waiting for some certainty there?
Yeah, well, the main thing when it comes to talking about the demand is earlier this year in February, we saw the first home buyers were coming back strongly into the market. They'd been sitting on the sidelines for a couple of years, watching prices fall, initially watching them soar through the roof in 2021 and sort of getting out of control there, and then interest rates were high, etc. But earlier this year, while they didn't really react much to the interest rate changes, they could see the listings numbers were very high. There really weren't many other buyers in the markets. They had wages growth, they had jobs, feeling secure about that. So the key point so far for this year has been first home buyers moving into the market with increasing numbers from February. And then ahead of the election, we've been seeing prices rising. So we've got about 4 months worth of prices going up now. We've seen sales firming as well. And the point I've been making to the first home buyers has been, there's a point at which maybe the investors will come back into the market. And that now is the second interesting thing we're seeing happening this year. The investors are starting to step forward. I found some who were ahead of the election, but most were going, I'm going to wait and see what this outcome is going to be. And now it's going to be a national dominated government. I can definitely see from my surveys, especially one I've just conducted there, that the investors are looking at getting back in the market. So my main comment that I'd make now is the one I've been making for over a year, that young buyers have had a window of opportunity to make a purchase without much competition out there. That window is now in the process of closing, with the other buyers coming along.
Yeah, interesting. I've got a few friends, first home buyers at the moment, looking, and it's funny, as a first home buyer, it's such a daunting prospect, buying a house for the first time, and remember that really well myself, but it doesn't seem to be, there's never any winners in it. Before it was you couldn't get the deposit to the point, or the banks weren't going to be lending because of LVRs or anything like that, and now there's real fear around the interest rates, and thinking, shoot, am I going to have to end up here at 6 or 7% interest rates when my friends were paying 2% when they got into it? So have you got any sort of thoughts for those first home buyers and how they weigh up those things, or how do you normally share that with people?
Yeah. Well, the first point to note is that it's never an easy time when you're a first-home buyer. It's always the biggest purchase that you've ever made. It's always difficult. These days, we tend to describe things as being in crisis, but quite frankly, things were pretty tough. Like back in 1987, when I made my first home purchase, 1 month before the share market crash, unfortunately, at 18.5% interest rate. So the price definitely lower. Up until 1992, the average ratio of house prices to incomes in New Zealand was 3. So think of your average income, house price was 3 times that. Now you're looking at 7, 8, 9 times that. So the price relative to people's income has definitely changed. But of course, interest rates are much lower. And even at the moment, you might pay 7.3% or so. Well, it's not the 18.5% back then. And with regard to the comparison of their friends who borrowed at 2 or 3%, etc., well, first of all, most of them now have rolled on to 7% because they didn't do what I was saying so strongly in the second half of 2020 and first half of 2021, which was lock in 5 years at 2.99%. And I didn't say that because I had a view that interest rates were going to go up. It was more just, seriously, mate, this is the lowest interest rate we've ever seen. Not a single sane person thought we'd get this low. At some stage, they're going to go higher. And what I actually advise people to do at the moment when you're trying to get a feel for, is this a reasonable interest rate or not? Get yourself a graph of the interest rates, completely block out, just get your white pen or whatever and block out 2019, 20 and 2021. Take out those 3 years when interest rates were unusually low, because you're not going to see that return again unless you've got A, worries about deflation in New Zealand, prices falling, cost of living going down, and B, a global pandemic. Ignore interest rates over that 3-year period.
Yeah, nice. I was in my previous job. I used to run the home loan book for KiwiBank, and I was there actually when we bought in the first 5.99 interest rate, and that was a massive thing. Like, so it was a stressful pricing committee getting people across that line. It was like these were unheard of. And then of course we got to the 4.99s. I was gone by the time they were doing 2.99s and all this sort of stuff for 5 years. But it's funny how quickly you adjust your normal, isn't it? It's like, all right, well, this is normal now. And,
exactly. That's a good point, just jumping in here. Adjusting to normal. We are humans. We adapt to changing circumstances. And this is where you see people talking about, interest rates are high, it's troubling. Well, as each month goes by, more and more people start thinking, maybe 7% is the new normal. How do I make these numbers work? So monetary policy can actually lose its effectiveness in suppressing the economy as each month goes by. People think it's the opposite, but no, we adapt. We build up savings, and hey, around the planet, lots and lots of people built up savings. In fact, during the pandemic, we couldn't travel internationally, so and we had jobs, etc. Wage subsidy scheme in New Zealand. So it didn't really surprise me that we saw the first home buyers buying strongly from early this year. And of course, we got the data from CoreLogic just the other day showing a record 28% of recent property sales were going to first home buyers. So I think the first home buyers, many of them from 2 to 3 months ago, got a feeling maybe the writing is on the wall here. There will be more buyers coming back into the market, and now the prices are rising, got to get in. And so I did an interview with some other crowd the other day, and they were saying, are the investors going to jump in now? Some are moving in. Personally, I think it's now going to be the first home buyers pressing the button, getting in before that window of opportunity completely closes.
Right. It's such an interesting point you just made there on the effectiveness of interest rates once you start to think it's normal, or get that impact. And you don't really ever hear, when the Reserve Bank comes out, they don't talk a lot more about the behavioural sides or what the humans. But do you think that's something that's going around the table there when they're thinking about, look, is the OCR really at its peak here, or do you think there's still some, what's your view on where that's heading, and also just what goes around that table when they're talking about that?
Yeah, well, a lot goes around the table, I would suggest. There are so many uncertain factors in play these days. I'd suggest there's not a single person can sort of sit down in whatever their economy is and say, this is what we really think is going to happen. We're really confident this is going to be the outcome. In fact, when I give talks around the country, I spend a lot of time saying, do not expect whatever forecast you are making at the moment that they will prove correct in 6, 12, 18, 24 months' time. And here's a list of reasons why your predictions will be wrong. Write down these reasons, because you can drag them out again in 12, 18, 24 months' time and say to your boss, say to your spouse, well, it's no surprise that we got this wrong. Look at what this bloke said. We can't predict. Look at all these uncertain factors. And not a single one of us knows what's going to happen in the Middle East, for instance, what that does to oil prices. Hang on, that means inflation, but it might mean a world recession. Hang on, what does that mean for interest rates? They look like they're going to go up, and then they're going to go down. So in this sort of environment, if one is looking at making a purchase, or you've got your previously low fixed rate coming up for renewal, don't completely discount going slightly longer towards 2, maybe even 3 years fixing, because frankly, no one's really had their interest rate forecast right on this planet since about 2007, I'd say.
You've probably touched on it now, but I saw a graph the other day, I think it was CoreLogic one as well, showing the difference between house prices following newer national government versus new Labor government, and they're pretty quick. Within 3 to 4 months, there was quite a pronounced house price increase, assumed delivered off demand there. But just interested what you think now coming into the Christmas and the summer season, and also how much of that is down to the likelihood now that we've got a national ACT government.
Yeah, well, first of all, investors coming back into the market, because when we saw on March 23, 2021, the Finance Minister announced the tax changes, interest expense deductibility disappearing for investors, the investors as buyers ran for the hills. They were out of there. There has been no wave of investor selling. There has not been dumping of property on the market, but the investors as buyers basically disappeared. So we have to expect that as interest expense deductibility comes back, even if it's not fully back 100% until the middle of 2026, the investors will step back in as buyers. So A, there is that demand coming along. B, however, there's also going to be some extra sellers. I do a monthly survey of existing property investors with Crockers, property management people, and I did the survey last week. I can definitely see an impact in there on investor behaviour from the election outcome. And one of the interesting outcomes that I can see is there's an increase in investors saying, I'm going to sell in order to buy another property. And that's basically gone up sharply. So there are actually going to be more investors thinking, okay, if this 2-year bright line test now comes back from 10 years, finally I can switch my properties around and get rid of this meth house I've been trying to do up for the past 3 years or so. So they'll sell and they'll make a purchase. So for real estate agents, it is going to get busier. Having said that, I've got, I guess, a personal view on activity going into Christmas, New Year. My feeling for the country overall is we're just over it. We're battered. We're in this post-pandemic environment of the high interest rates, the cost of living, the election, many things in crisis, bad news overseas. I've got this view that many of us, with the election gone, we're going to leap straight to, it's almost Christmas. Oh, thank goodness it's the end of the year. I can partly gauge this by the number of emails I receive, the number of people clicking through to my regular weekly publication, etc. A lot of people have turned off, so I don't think it's going to be a boom in real estate turnover heading into summer. A lot of people, I think, are going to look to take a break, turn the brain off as early as humanly possible.
Yeah, interesting. The interest rate deductibility, do you have a sense of how much that changes the numbers for investors on the affordability?
Yeah, I don't look at these things in detail myself, but it clearly changed the numbers if we look at the strong reaction of the investors disappearing from the market in end of March 2021. So they'll come back in. I think in the combination with the high interest rate. So if we were still in a lowish interest rate environment, let's say 5% for mortgage rates, then maybe not a great level of impact. But you put 7.5% mortgage interest rates in there with the removal of the interest expense deductibility, and the numbers here do not work out for a lot of investors out there. They haven't wanted to sell into a weak market. Now the market is picking up. Some will have already made the decision of maybe the rules change again in the future. We're going to look at some diversification. So out of this, I do expect to see some people looking maybe to move into, diversified equities or something like that, where you don't tend to get these rule changes, because one day National will be voted out, Labor will be back in, the rules will probably change again. And so that has to factor into people's long-term property considerations, especially as most investors, they're not flippers, they're in there for the long term. So they're going to have to factor that potential change in, who knows, 3, 6, 9 years down the track.
Yeah, we've also got the sort of 39% tax bracket there for the first time as well, which will be impacting a lot of them too, right? Like, previously around this deductibility, the rate was probably lower, but although I'm sure there's a lot in trusts and stuff, but it is... It's just really interesting to see how quickly the sentiment on that changes as well. And I hadn't really thought so much about the ability to get out, right? It's not, you're right, the numbers show that most investors are there for the long term, but the fact that you can get out in 2 years and not need to pay a capital return still does change your thinking quite a lot
For some of them, yes. Like I say, for real estate agents, there will be some more listings coming forward. But again, my warning to first-home buyers is don't think there's going to be a listings rush out there. The housing market is now rising. In a rising market, why would you be in a hurry to sell? The upward leg of the house price cycle in New Zealand tends to last for maybe 5 to 6 years. I mean, that doesn't mean it peaks strongest rate of growth in 5 or 6 years, but prices tend to go up over that period of time. We are now, late October, only into month five of the upward leg of the house price cycle. If I happen to have, properties, if I were an investor, I would not personally feel in a hurry to sell. I'd wait, especially because of the other factor we haven't even talked about yet, sort of two things out there. Number one, there's a population boom in New Zealand. The migrants coming in, it doesn't mean the migrants are buying houses, but it means the existing tenants are having increasing difficulty finding properties. Landlords, they are at a record level of easiness of finding good tenants. They can pick and choose. From my survey, I can see extra upward pressure starting to appear on the rents. So A, population boom, pushing rents up, push prices up. B, house construction is falling and likely will continue to do so through to early 2025. And C, at some point, interest rates will go down, maybe second half of 2024, slowly. But we've got house prices rising with interest rates high, with interest rates having increased over the past 6 months. It shows some of the strength of the underlying other factors.
Yeah, so one of the big drivers, and you have touched on it there, but lots of those levers, but of course under the National Plan, they're keen to bring back some foreign buyer or some foreign investors. Just interested in your view with New Zealand First, if they do end up being part of this government, and that's something they're being quite against. What do you think sort of levers they have there? Is that something you expect to go away, or do you think that's a firm part of the plan?
Yeah, no, I would say that will probably get across the line, that we probably will see foreign buying, beyond Australians and Singaporeans who can still do the buying, for properties 2 million and over, and the national government attempt to collect, I think it was their $740 million worth of revenue a year. As I've been saying to people over the past couple of months, when you go to watch a movie or a play, you engage in something, I think it's called a willing suspension of disbelief. You watch the movie, you know there's not really a spaceship. You know this person can't really fly in an iron suit, but you suspend your disbelief. And that's how I think we approach elections. We know they're not going to collect $700 million, but hey, what the heck? And for Labor, well, it's not going to cost only $300 million for free dental care for 29-year-olds and this sort of thing. But the tax change, it's not really relevant to first-home buyers. Not many first-home buyers out there looking for a $2.1 million property. It's relevant for the upper end of the market, but as I think CoreLogic may have estimated, there's only about 55,000 houses in New Zealand priced at over $2 million. So, we're not talking, I think, about a large impact on the market overall. Not really relevant for your younger buyer.
Well, something that might be then is the national, Andrew Bailey, I think, has the policy where he said that he wants to roll back some of the triple CFA rules. So triple CFA, the Consumer Credit Contracts.
Credit Contracts and Consumer Finance Act, I think.
That one, yep. There's got the three C's in the wrong way. Do you think that's likely to impact the way the banks are lending at all and maybe give some further relief for first-home buyers?
Yeah, it depends on how much tweaking they do. If they said we're scrapping the changes in the triple CFA that happened in 2021 and we're going back to the way we were, I have to say this is going to lead to extra credit being made available, because when those changes came in effective December 1, 2021, it had an impact which none of us beyond the banks themselves had anticipated. At the Select Committee hearings in the middle of 2021, the banks were making it clear to the MPs on the committee there what the impact was going to be. Credit would cease flowing to a lot of people, and the MPs didn't appreciate that. David Seymour belatedly said he heard it all and sort of didn't believe it and sort of missed out what they were saying. So you have to think, if there is a wholesale switching around of the triple CFA rules, more credit will flow to first-home buyers, owner-occupiers, investors generally. And for the banks, if they're favouring borrowers, then it is first-home buyers. It's not really the investors at the moment. And so I'd suspect any triple CFA changes will have a greater impact on making house purchase more readily available to investors out there, as opposed to the young buyers, maybe even the owner-occupiers to some degree as well. But it's pretty vague as to what the changes would actually be. I don't suspect it's going to be necessarily a priority for them, but it would be one of the factors I would put on my list I've been highlighting for quite some time now. This is why house prices are going to rise over the next 3, 4, 5 years or whatever. Population, one day interest rates fall, falling construction, increasing materials prices, etc. And of course, maybe a tweak, of some degree on the triple CFA.
Yeah, and just out of interest, because often we can, we do a lot of comparison between towns, Wellington to Auckland, Christchurch, within New Zealand as well. But you hear less and less about comparisons over to Sydney, and Melbourne and these places where I imagine there's a lot more houses than 50-odd thousand over the $2 million price point. And of course we're not far away. So how do you bring in Australia to your assessment when you're looking at that as well, and at where house prices are going to be heading?
Yeah, don't. Don't. Yeah. It's a red herring. Whenever house prices are high in New Zealand, rising strongly, we get people looking at studies of, look how expensive New Zealand is with overseas. We're stupid. It's crazy here. How's a young person going to afford a house, etc.? I'm out of here, man. I'm going to Sydney. Well, why aren't you going to Suva, where it could be cheaper as well? So I'll throw that in there. There's always a cheap location. If you want a cheap house in New Zealand, go to the west coast of the South Island. Beautiful location, and I think the median price is about $350,000. Now, with already one child in Perth, another one shooting off to Melbourne, don't know where the other one's going to end up. There's 5 all told there. They have no idea that when you shift from New Zealand to Australia, what the tax rates are, what rate of increase in wages is going to be, what the house prices are, insurance costs, nothing like that. It's simply the big bright lights and you're going to go there. And that's the attraction, I think, to people. I don't think many people are going to do a comparison of how much will it cost to buy a house in New Zealand versus Sydney, Melbourne or Brisbane. That's why I'm going to move across there, because I spend quite a bit of time in Australia now, and I can assure you that there is massive discussion over there about rising house prices. They've already increased 5% plus in your Sydney and maybe a couple of other capitals so far from early this year. Their markets in Australia turned in February. Canada turned in February as well. We turned in about June with prices rising in New Zealand. So yeah, be careful of the international comparisons. I don't think it drives the market here in New Zealand at all. Look at New Zealand specific factors. And while with this discussion we're having right now, one might be thinking, okay, look at all these Kiwis disappearing to Australia. Isn't that going to depress the housing market? It's a numbers game. And with a net migration gain in the past year of 110,000 people, what is that, 2.1% of the population or something? It's obvious what it does to rents, property availability, house prices.
Yeah, it's a big number, isn't it?
Yep.
Back to talking about people with home loans at the moment, how many of them have we still got to see? I suspect a lot of them are through the pay now. By that I mean they're onto the 6 or 7%, but how's that rolling of the book looking? There'll be some smart people on that 5-year 299 still happily patting themselves on the back. I'm not one of them, but
yeah. No, there are a few out there, not many. We Kiwis, we tend to fix at whatever term is the cheapest by and large. So that's why I'm not overly critical of people who took the candy and locked in for 1 year at 229 or so back in late 2020, 2021. There's still a few left. I haven't looked at the numbers recently myself, but there are still a number of people, and they're not now rolling off 229 to 7. They are now rolling off maybe 4.5%, 5% onto 7.3. So there is still some restraint that is going to come along, generally on consumer spending. But remember, these are people who already have mortgages. They are not fresh buyers. So this doesn't really, this rolling into higher rates, have an impact on what we've been talking about earlier in terms of going into Christmas and next year overall demand for properties out there. It's more just the cash availability for people generally. And the labour market, it's certainly more in favour of employers now. They can do a bit more picking and choosing. But overall, job security I'd perceive as still pretty good there for most people. And as more people roll into higher rates, a bit of extra restraint on household spending, not really an increase in mortgagee sales to any great degree out there. There is still a bit more pain to come for consumer spending from people who've used up savings that were built up during the pandemic. This receives a lot more attention, especially in America and Australia. Numbers in New Zealand sort of hard to come by, but a lot of those savings have probably all been used up now, and this will be one of the things the Reserve Bank discusses, as we were saying earlier, around the table. How much extra pain is still to come along from these people basically rolling a few more into higher rates out there and having used up their savings, etc.
Yeah, there is a pretty good portion of, well, nowhere near as big as on the debt side of it, but a portion of people that we haven't heard a lot about in the news and stuff at the moment, which are the people who are now all of a sudden receiving 5 or 6% for their deposits that are sitting in the bank, and where they were probably bloody close to nothing, excuse the language there, not so long ago. So have you got any data on those people and what they're doing with that money, or have we just got some people who are accumulating at the moment?
Yeah, not much data at all. You'd have to think for a lot of people, if they're in that situation, they will be obviously older, they'll be a bit more cautious, they'll be thinking about maybe, like I say, diversifying, they might want to get some equities, etc. But of course, we've got a lot of uncertainty in the equities markets at the moment, where it's like, you open up the news in the morning, have the Israelis gone into Gaza Strip? What's going to be the reaction? Are we going to see oil embargoes? Now, there's two generations out there maybe don't know what I'm talking about there. But in the 1970s, there was an embargo on shipping of the oil out to the west there as a result of a conflict in the Middle East, etc. And the price of oil quadrupled over 1973-74, and then again it about doubled with the Iranian Revolution in 78 or 79. And that's when you got your carless days, etc., terrible economic policies and all this in New Zealand. So, that major uncertain factor does still sit out there. And I guess that says to me that for a lot of people who have money sitting on term deposit at the moment, they may want to diversify into some other things, but there's no great push factor at the moment because they're getting 5.5 or 5.7%, etc. Out there, and there is still a lot of uncertainty. What that means is one day when the uncertainty is less, there will be obviously a reaction in the equity markets from that. But a lot of people just sitting there, and the rule of thumb is when you're doing well, be quiet. It's like the farmers know this in New Zealand. If you're doing well, the prices are high, the currency's low, the weather's good, just take photos so you can remember it during the bad times, and be quiet. But when tough times come along, remind people in New Zealand where the ultimate driver of our economy comes from.
We might wrap up about here. I think, Tony, this has been amazing and super insightful, but maybe I'll just ask you to recap quickly. If there was one takeaway from the episode that you think that investors need to know, from what you've shared with us today, what do you think that would be?
Yeah, my main takeaway would be I've been pointing out for over a year that the list of factors going to push house prices up is longer and stronger than the list of factors pushing them down. Completely ignore talk about it's unaffordable. Look at New Zealand compared with overseas. That is an outcome of all the economic factors, but not a driver of where the housing market is going to go. House prices in New Zealand, they usually have upward legs on the house price cycle of 5 to 6 years. We're into month 5. So we are going to see prices rise, especially as we continue to get strong migration flows by the looks of it. Interest rates one day falling as well. And like I say, just remember, house construction is actually falling at the moment. So go back to your sixth form, year 12 or year 13 economics text or first year economics 101 and resurrect your knowledge of supply and demand curves. So this is the ultimate comment. And move the demand curve because of population growth. Shift the supply curve the other way because of less growth in house supply. See what it does to the price equilibrium point. It puts it that way, and that window of opportunity for a lot of first home buyers to make a purchase, it is closing. Hey, there's a good 6 months left maybe, but watch out. The investors are coming back into the market.
Very helpful. Thank you, Tony. Funny how you can bring it back to ultimately quite a simple principle that a lot of us learned in early economics, right? Supply and demand. And fundamentally, 5 or 6 years ago, pre-pandemic and some war and stuff like that, pre-inflation, that was the same thing. The fact that we've got more people coming into New Zealand than we have going out and than we have houses for. Right, we're going to wrap it up there. So thank you so much, everyone, for tuning in. You can watch Shared Lunch on YouTube or follow us on the podcast on Apple, Spotify, or wherever you get your podcasts. Leave us a 5-star rating and a comment with who and what you'd like to hear about. BusinessDesk is offering Sharesies investors free access to its business news service until the 30th of November this year. That's getting pretty close, so get onto it. But to start reading breaking news, analysis and commentary on a wide range of topics for free, follow the link in our description. You need to be a new BusinessDesk subscriber and use the link provided to take up this offer. From December, you can continue at a discounted annual rate and receive a complimentary full subscription to the Wall Street Journal. And there's lots of interesting news happening over there at the moment. So thank you, everyone. Enjoy the rest of your week.